David Jaffe with BestStockStrategy.com, on YouTube at youtube.com/BestStockStrategy. And I'm here with Bassem. Bassem, would you like to introduce yourself?
All right. Hi, everyone. My name is Bassem Zahili. I'm a full-time accountant, part-time realtor, part-time YouTuber, and options trader. I usually I have a YouTube channel under my name, Bassem Zahili, where I talk, half of it is Canadian finance and half of it is options trading, where usually once a week I try to release on Tuesdays, where I just film myself trading and talk the audience through my trades and my plan for the week. So thanks for having me.
Yeah, it's my pleasure. Can you discuss your trading strategy and perhaps also touch upon some other strategies that you tried in the past?
Okay, nice. So I prepared for this. I wanted to make sure I do a lot, so I wrote down a few notes, which I'm going to read. My main strategies: cash secured puts, strangles, and my newest one is a poor man's covered call, which I really like. I've done it. Okay, so I did it on Tesla, and obviously Tesla is shooting to the moon, so it's been working out pretty well. But my other strategies, I used to do 0 day to expiration SPY credit spreads. I used to do that. I started that in the pandemic when I was working from home, but now that I'm back in the office, I can't day trade. I can't be on my computer all the time. So I went from 0 day to expiration trades to now I'm doing monthlies, just because, I'm a full-time accountant. I can't really show people. I can't really let my boss see that I'm trading, but I still try to do it on the side. One of my favorite plays, if it works out, is just earnings plays, just hoping for IV crush. Even if the stock goes against you, it still can work out. I usually do it on AMD, Apple, and NVIDIA. And when NVIDIA was a lot higher, I know NVIDIA's they did that stock split, so my bearings are all off. But but it's been working well. It's been working out really well. How about yourself?
I usually sell puts. I use margin, and when I believe that the market is oversold, then I'll sell a put. If I think that the market is overbought, then I'll sell a call option. I tend to keep a very small watch list of about like 10 or 15 securities, and then I get comfortable with their trading range. And then when I believe that some of those securities are trading at their price extremes, I'll then sell an option to fade the move, usually with an expiration of anywhere from about like 4 to 7 weeks. And what's good about waiting for the price extremes is that you're able to collect a significant amount of premium because it has relatively high implied volatility, and the implied volatility rank is relatively high. So once you get comfortable with the trading range and they're very large liquid stocks, then you can sell an option and collect a lot of premium. So a few things that you mentioned in your intro, which I found really interesting, how did you enjoy like 0 DTE? Were you very successful with that? And can you compare that relative to your current strategy? And I know that this is a bunch of questions, but also what's your like bread and butter trade? Because you mentioned, I think, 3 things that you primarily do with selling options.
Right. So the 0 day to expiration, I tracked it religiously. I have a giant Excel, which I share with anyone who requests it, that shows I tracked over 1,000 of my trades. 0 day to expiration, I was successful 102 out of 106 times. The issue is those 4 losses it wiped out a lot. So every loss would probably wipe out 10 trades, just because if it moves against you, usually I kind of wait till last minute to manage it, because I'm like, hey, what if it comes back? If I do a put credit spread, and I'm like, what if it hits my support and it bounces back up? So usually my mistake with those 4 losses is waiting too long. I implemented a new rule where I'll close at 3 times when my loss is 3 times my gain. So if my credit spread gave me 500, my new rule is to close when I'm losing 1,500. Well, in the past, my first loss, it was about like 10 times. So when I made 500, I kind of lost 5,000. I wasn't too upset because I probably had 40 successful trades, and then I lost that one, which wiped out, let's say, 10. I really did enjoy it. It makes it it's more active than what I do now. My bread and butter, I find, is just cash secured puts. So I've been trading options. let's say for 12 years, but I used to do, my first 8 years were just basic. So I had dividend stocks and I would just sell covered calls on the dividend stocks just to double dip in my gains. And then as I got more comfortable and when my portfolio size got large enough, I started selling the cash secured puts. My new rule, which started January 2021, is never to accept shares. Whenever I sell puts and I accept shares, my timing is perfect. It always ends up tanking and I end up losing. So now I find I'm much more successful when I just sell cash secured puts and then I'll roll it down forever.
Yeah, I agree with you. I think the problem with the wheel strategy, and actually I have an upcoming video that I recorded but I haven't posted it, is that even though you're able to accept assignment at a lower price than what it was previously trading at, you are also going to participate in the downside as well as the upside on a 1-to-1 ratio. So not only is accepting stock less cash efficient, although if you're trading cash secured, then there's no buying power discrepancy between being long shares and then also and then also selling options. But additionally, I think on the negative side, the other negative is that you don't have that safety net, because when you sell an out of the money put option, you inherently are built in with that safety net between where the current market price is and where your strike price is. However, once you start accepting assignment, then if the stock ends up going down by an additional like 5%, then that's immediately reflected in your P&L. So for me, I don't accept assignment, and I understand like the logic behind it, like running the wheel, you can sell out of the money call options, etc. But I would much rather not have the stress. And because I use margin, I would much rather always have that safety net while also realizing the capital efficiency while trading on margin. So I definitely agree. And I think actually when I was speaking to another Canadian trader on my channel, and I believe he's also, he might be a CFA or an accountant as well. From what I recall, like one of the things that he did, it was Shahid, one of the things that he did was when a trade would get challenged, I believe he would roll it over and extend the duration, but then roll it over to the same strike. And I believe now what he's doing is when he rolls over and extends the duration, he's then using that additional premium to reduce and roll it to a more favorable strike price. And I think that by far is the better thing to do, because you can roll an because I believe that once a trade is challenged, your primary goal is to get rid of it because it's causing you stress and there's a little bit of increased risk. So if you can roll it forward by 1 week, by 2 weeks, and pick up some additional premium, you can then allocate that premium towards significantly reducing the strike price. Like if you're short an 80 strike put, and let's say that trade is getting challenged, you can roll it forward by 2 weeks and then roll it forward to about like 75. Something like that.
Yeah. So it is interesting you brought up the wheel, because like I am filming a video on why the wheel, when it doesn't work. My mistake the last time I got assigned was in January, and it was on Workhorse. I know people are saying you shouldn't sell puts on garbage stocks, and that is a garbage company, which I learned the hard way. So Workhorse was around $40, and I was selling puts on it at 28. And they ended up losing a USPS contract. They went from 40 to 28. So then I rolled from 28 to 20 and it ended up tanking. It's now at $7. I decided to accept assignment at 20 and now I'm at a $13,000 loss. It is impossible for me to sell. Like a lot of people say, oh, you just sell calls at the strike, so you kind of break even.
Like much premium.
Yeah, no, I'll be earning a penny. So I've been selling covered calls just at like $10. I'm slowly trying to recoup my loss, but I'm going to tax loss harvest and just sell it December 31st. So I can use that loss just to offset some of my income. So just so I can pay less tax. But my new rule, I'm just never going to accept shares again. And you're right, it's just more cash efficient or margin efficient, because I am trading on margin more now as I feel more comfortable.
That's good. So going back to that Workhorse example, I guess, and I don't know how long it took you to, but I'm not familiar with that stock, so I don't know how long it took, but I would assume, like 10 months or so. But do you believe that if you had rolled that down from 40 to like 35, etc., then you would have been able to rid yourself of that position before it before it collapsed, or did it collapse like relatively rapidly? And you think, because remember, like you accept assignment, but even if you roll out of position, then the position still has to expire worthless before the stock would trade below the strike price. So in your opinion, would you have been able to roll it and get rid of that position prior to it having fallen all the way down to below $10?
Yeah, for sure. So it was a little bit of greed on my part. There was so much IV in that stock that I was able to roll it. I could have rolled it from 20 to 18 to 16, but I was making a lot of premium by rolling it at the same strike, which is what you mentioned Shahab did. So
Yeah.
I got greedy. I took the premium for myself because I was convinced it would come back. And then, I'm learning from my mistakes now. Just cut your losses and run. You brought up a good point. Not necessarily if I broke even, the money is important, but then the stress it caused me, I don't think it was worth it. So the stress, I like that you brought that up because it is an important factor that I kind of want to avoid in the future. And I've been avoiding it since this lesson.
So two really important takeaways for the viewer here is you have some incredible Canadian traders, both of whom they indicated that had they used the premium when rolling a position and allocated it more towards risk reduction by reducing the strike price on a challenge put option, or if you're trading a call option and increasing the strike price. So as opposed to being in the mindset of collecting as much premium as possible, then you could simply allocate that premium towards rolling it to a more favorable strike price. And the second important point is, and I don't think that there are enough YouTube videos on it, that the stress is real when you have a challenged position. And I think that especially when you sell options, your win rate can be incredibly high. Oftentimes it's over 95%, sometimes even over 98%. But the problem is that if you have a stressful position, I believe that the goal should be to try to rid yourself of that position while also managing your downside risk as much as possible, and really not trying to play game. I wouldn't say like play games, but just try to do everything possible to rid yourself of that stress, because you don't want to have a portfolio with 10 positions on and feel a compulsion to constantly check a position. Or, I mean, no offense, you also don't want to be in a situation where where you're constantly reminded about a bad position for 10 months. It's just not positive psychology to log into your account and then see a relatively large loss and be constantly reminded and having to always sell calls and then, et cetera. So I'm glad that you have an exit strategy for that as well.
Yeah, so it's not like you are right. Like most of my trades, I think with selling out of the money cash secured puts and then managing them, my trades are over 90% successful. But then seeing this like negative 10,000 constantly for the last 10 months on my portfolio, I always make jokes about it. My viewers keep asking if I'm ever going to recoup my losses. And I'm like, no, I'm not going to, but at least it'll reduce my tax burden in the future. So I'm trying to look on the bright side.
Yeah, definitely. What else did you learn about? Have you changed at all because of that situation with Workhorse? Have you changed the specific type of underlyings that you target? Are you now trading like larger cap companies, or are you trading stocks which have more liquidity and more volume? Or is that pretty much, because hey, like part of it is just, it could just be bad luck, right? Like you said yourself, had you rolled that position and not take an assignment, then you would have made money on it. So I don't want to conflate that. Sometimes, luck is a part of trading options. So when you because you have a loss on Workhorse, did that also modify your strategy a little bit regarding the underlyings that you're choosing to sell options on?
Yeah, definitely. Because a lot of the times I like high IV stocks because it kind of earns a lot of premium. But then this is a new EV company where it's like a Tesla competitor and like a Neo competitor, but they weren't proven yet. They didn't have any income. They weren't making money. It could have been a good bet, but I was chasing the premium instead of, probably just selling puts on a company I believed in, like AMD or Nvidia or Apple. I don't think fundamentals are the most important thing for selling puts because or like selling options, because I'm not going to accept assignment ever again. But it can't be like a fraudulent company. Like if you've heard of Nikola or what happened with it last year, it went from $80 to I think it's now 6 or 7. I'm going to try to avoid those like Wall Street bets type hype stocks where it just doesn't really make any sense. So I'm just trying to go with more legit companies that don't have those 30-40% a day or a week movements. Although it'd be nice if it goes your way, but chances are you might end up at a loss like I did.
I think that's one of my main criticisms of Tasty Trade. And I think overall, Tasty Trade they've done significant positive and added a tremendous amount of benefit to the option selling community. But at the same time, they are relatively, they're like company agnostic, where they primarily just sort and choose underlyings based upon implied volatility rank. And then whatever company has a really high implied volatility rank and a very high expected move, because obviously, you know, the estimated move is oftentimes more than the actual. The problem is that when you sell only high IVR stocks, then like you said, you have a higher propensity for having like fraud, or you just have a very high probability of you having like smaller companies which have larger outsized moves which can cause you a lot of issue. For me personally, I believe that it's much better to stick to strong brands. And because I'm selling options at price extremes, then I actually don't even look at the IVR, because inherently when I believe a company's at a price extreme, then there is more available premium at that specific moment inherently. So I understand that from a Tasty Trade perspective, they indicate that, hey, like, let's take as much subjective thought out of the process as possible. If it has very high IVR, then sell that because you collect a lot of premium. And then in the worst case example, you can roll it. The problem is that I always try to reduce stress. And when you're dealing with very strong brands, I don't even have to read any news clippings or anything. Like, nothing that you read about Apple or Nvidia or AMD is going to improve your decision-making process, because those companies are so large that everything is already priced into the stock. So there's no informational advantage. And that's why I love it. And you're also protected because it is a strong brand. And also those brands, it's pretty rare that, like Workhorse, you said, went from, I think, like $40 to about, was it like $10 or something like that?
It's at
like
7 right now.
Yeah. So figure that, Apple is not going, Apple's not going to drop from, wherever it is, like 135, 140, all the way down to like, $35. I mean, that would be pretty rare.
Yeah.
I mean, I guess it could happen, but it's not going to happen during a bull market like we've had in 2021.
Yeah, exactly. Like I did learn my trading strategies from Tasty Trade. So I apply Tom Sosnov's strangle method, like just a modified version. So he likes to do 45-day strangles. I like to do 30 just in case I need to roll it or manage it. I don't find much premium after like 60 days. So if I'm at 45 days and I need to roll it to 60, and what if I need to roll it again to 75 or 80? I like to start a little shorter so that if something bad happens, I have that extra theta I can earn by selling that extra time. So they definitely help, but you're right on the whole IV issue. They like to choose the highest IV, which I take advantage of high IV sometimes. Like I do some very risky trades very rarely, but just when I think it'll be like a 99% chance to win. I don't know if you've obviously been paying attention to the AMC fiasco. When AMC shot up from $9 to 72, I ended up selling naked calls on it. Sounds very dumb, but I chose 5-day to expiration naked calls at 150. So AMC needed to go from 72 to 150 in 5 days, and that was a risk I was willing to take. I think the IV percentage was like 1,000 on that trade.
The only issue that I have with something like that is, if you remember, with the other company, GameStop, it actually went up from about like 80 to about like 300 in like a few weeks. But also, not only do you have the price risk, but you actually run the risk of having the brokerages change their margin requirements on the stock and have it use up a tremendous amount of margin, especially if it's going to be on the short call side. You mentioned a few interesting things which I think are valuable. So I think that selling shorter dated expirations, especially on positions which are a little bit more inherently risky, is better than longer dated. And part of the reason is that when you are selling shorter dated, if that trade gets challenged, it's significantly easier for you to manage and roll that position. For example, let's say you sell a 30-day DTE, and then let's say it gets challenged at about 14 days. You can then roll that position out about 2 weeks and collect a significant amount of premium and then allocate it to the strike price to roll that strike price to a much more favorable situation. If you initially sell a 60-day DTE and then that trade gets challenged at about 45 days, instead of rolling it 2 weeks, you might have to roll that same trade by 2 months in order to realize the same benefit when you're rolling the strike price. And as we said previously, if a trade is challenged, my goal is to reduce stress and get rid of it as quickly as possible. Another thing that you mentioned that I felt was really interesting, I tend not to sell strangles unless it's opportunistic. So if something is at a price extreme, let's say I believe that it's oversold, I will sell a put option. And then usually if something's oversold, it's kind of like a rubber band where it gets like it snaps back relatively quickly. Yes. And then so if I sell a put and then the underlying stock ends up appreciating in value very rapidly over the next few weeks, or rather over the next few days or the next week, and then it becomes overbought, I'll then opportunistically sell a call option, and therefore I will have a strangle on. So but I don't like putting on a position as a strangle, because if it's a good time to sell put, then inherently it's a bad time to sell a call, at least with the way that I trade, because I'll only sell a put if I believe that a position is oversold. However, if there's an earnings play, so let's say there's earnings coming up like this week, what I will do sometimes is I will sometimes put on a strangle that expires for this. Let's say the earnings is on Tuesday, just hypothetically speaking, I will sell a strangle with an expiration of this Friday, and then the day of earnings, once it announces it, or the day after, I will close it out for, hopefully a profit. So usually during the normal course of trading, I won't use strangles. However, I will use strangles if it's an earnings play, and then I will go relatively far out regarding my strike selection and then close it out after the earnings announcement.
Right. Yeah. I love the earnings play, because it could even be a day or two where you could be that IV crush just it can earn you like 50% within a few days. I usually sell strangles on slow moving stocks like AMD and Nvidia, not recently. So the strategy works until it doesn't. So AMD, the reason why I like strangles is that, you predict a range, and then with 30 days to expiration, if something happens, you can move the whole strangle to follow it up or down. Right. So AMD, I've been doing it for 9 months, and I've been following it from $50 all the way up to now it's like 110, with no big issues. So I think I've been selling 10 strangles. Just for reference, my portfolio size is 550,000 US. It's taken me 12 years to build that. I'm going to leave that for later. I have another question I want to ask you, just specifically to portfolio size. But yeah, I like the strangles. I usually open them up 30-day to expiration, 15 delta. And then because AMD and Nvidia are relatively slow moving, I can move them. I can follow them up or down, just depending on what happens with the stock.
I think Nvidia recently has been relatively slow moving, where it's been kind of like a sideways market, like over the past month or so. But yeah, up until about 6 weeks ago, it was appreciating like pretty rapidly, and it was hitting new highs. But over the past like 5 or 6 weeks, it's been like there's been some two-ways actions, which are amazing for selling options because the stock doesn't really move that much.
Yeah, like so once they announced their stock split, that's when it started. It went up like 25%. I ended up, because I sold such a short-term expiration strangle. If you look at the previous 6 months, it was before the split, it was trading between 475 and 600 for 6 months. It was bouncing off that range perfectly. So again, a strategy works until it doesn't. 2 days before the expiration of my strangle, I knew I was going to close it out just to allocate my buying power somewhere else. I just covered the naked portion and I got the shares called away. And then it ended up mooning. Like I wasn't expecting like a 25% increase, but I guess like anytime a stock splits, I've noticed people just jump in. They think it's going to be worth more. It's funny, it doesn't really make sense if you think about it. Like the value of the company doesn't change when the stock splits, but more people are interested in it because all of a sudden it's cheaper. So that psychology, I need to incorporate that more into my plays.
Yeah, oftentimes you have like added liquidity, and then you oftentimes additionally have like the retail investors that couldn't previously afford the stock, and then they jump in during a stock split and they bid it up. One thing that I was really curious about was you were previously selling cash secured, but now you've moved over to margin. Can you touch upon that? Like, what was the impetus? What was the motivation behind that change? And are you only now trading on margin, or are you mixing it up between cash secured and margin, or what are you using for margin?
So Questrade provides a 3-to-1 margin, which is pretty good. I know, like I think Interactive Brokers offers like 6-to-1, which that's interesting. I won't touch on that. But as I got more comfortable with selling options, I realized there's almost like if I choose the right companies and if I just manage it, if I'm not on vacation or something, and I don't have access to my phone, I don't see anything that can go wrong. The worst thing I experienced was March 2020. I lost $20,000. I didn't believe the pandemic was happening. I just, I didn't think we'd see this black swan event. I've been investing since 2010, so I've never experienced a recession. Like I graduated university in 2010. Everything I did from 2010 to 2020 worked. It's like the longest bull run in history, I think. And everything I did worked, so I didn't believe that we were going to lose. And even though we like the worst thing that could happen to my portfolio did, I only lost 10%. And like I'm just not worried. Not everything has to be cash secured for me anymore. Like I know the worst thing that could happen, I can manage it. If I have to take a loss, losses are guaranteed eventually. Not everything can be 100% win. So I don't mind taking that added risk. And if anything, what I like about margin and selling puts is that when you roll down, your margin requirement decreases. If I rolled Apple from 100 to 70 to 50, that dollar amount decreases. So I'm just more comfortable and I'm not afraid what could happen. People think it's risky. Just given my experience and just being able to manage it, I'm an accountant. I work at a computer all day, so I'm always able to check. And also, I want to increase my return.
Right. I definitely think for traders who are disciplined, I actually think that using margin can improve their returns overall. And the reason is that when you use margin, and especially when you usually use it effectively, because it is a double-edged sword. But when you leave adequate buying power and enough safety net, then it protects you, because if you're only using cash secured, you might be more inclined or more motivated to trade more aggressive strike prices because you want to maximize your amount of premium collection. However, when you're using margin, then it affords you the opportunity to go further out of the money. And even though you're not collecting as much premium, you can make up for it with increasing your size a little bit. Now, you don't want to overdo it. There's always going to be a sweet spot. So that'll protect you against very large drawdowns like March 2020 or December 2018, or even, I think in February 2018, from like February 5th to like February 8th, or, that following week, there was a large volatility expansion. But yeah, I definitely think that using margin correctly can actually be a way of decreasing the portfolio volatility that you experience. Are you using regularly? I'm not sure if like how Canada does it, but do they offer like portfolio margin or spam margin or something similar, or no? or
Yeah,
is
so
it?
they do. Yeah, they do offer a portfolio margin. The part of the frustration with Canada, I don't know how it is in the US, but our retirement accounts and our tax deferred accounts, you're only allowed to do level 2 options. You're only allowed to do covered calls. You're not allowed to do any other options. So when I guess like it's a little deceiving when I say I never accept shares, because if you open my retirement accounts, I have shares which I sell covered calls because I have no choice. But with in the same Questrade account, I do have my regular margin, which does take advantage of the tax deferred amounts, and they give me an increased base. And all you have to do is just leave enough, like you said, leave enough room to manage in case something goes wrong. Don't use 100% of your margin, but it definitely helps increase the return. And part of the thing, I was kind of worried if I didn't use margin, was I beating the market? Like, was I beating SPY if I didn't use margin? And I think margin really helped me. At least I think I'm doubling the market, which I'm comfortable with. And yeah, it just it gives you more opportunity, more reason to manage, and like you said, less stress, and you can trade safer.
How many positions do you usually have on at one time?
Oh God, I have 20.
I think that's too much.
Yeah.
I mean, whatever works for you. I can just say that for in my opinion, I feel like because not every position do you have the same confidence in. So there might be like 10 positions which you feel like very strongly, and you log in and then you're like, okay, yeah, I don't even have to worry about that position. Maybe I'll let it expire, or maybe I'll close it out. I'll set like a buy to close GTC limit order, and then it'll automatically close out. But then you might have like 2 or 3 positions which you're like, okay, like let me watch those positions. And I feel like when I trade too many underlines, not only does it become a little bit overwhelming, at least for me, then it also, from my experience, I've done better by being more heavily concentrated and trading anywhere from like 4 to 7 positions, which I feel highly confident in, and just simply increasing their size. Now, I'm not saying that if you're going to trade like 7, that you trade like NVIDIA, AMD, Apple, just all highly correlated underlyings. Like I think that you should have like some type of diversification in the underlyings in your portfolio, but I do think that having like 20 might be a little too much. Although, I mean, Tom Sosnoff, he has like 80 to 100 usually. I don't know how he does it, and does a show. I mean, it's yeah, but I don't think that for many retail traders, especially if they're working full time, I think that less is usually more, in keeping it as simple as possible.
Right. Like a lot of people, the reason why I knew that would be too much. Everyone tells me it is too much, but one of my issues is I like to trade. Sometimes I'll just get that itchy finger and I just want to do something. So when I do 30-day to expiration options, and it's like, I don't want to wait another month to do another trade. So if I have some buying power, then I'll just start making a trade, just because my goal, if I could trade full time, I'd be the happiest person ever. Like I would not retire, I'd quit accounting if I could get my portfolio to 1 million. I'd feel more comfortable living off that income. Until then, I really like trading. If I could do it full time, I think that's why I have so many trades open. It's just, I'm, still learning. Like I've been doing it for 12 years, but aggressively for 4. So I was just doing covered calls in the first 8 years, and now I'm doing naked. I'm trying to do iron condors, which I don't like. But then now just the other side of it, which is strangles, which is the same thing, just more risk, but also more return.
Yeah, if I remember it, and I think that my call with Shihab was a while ago, but I think he also keeps like a spreadsheet, and he had about like 20 underlines as well. And then I believe he expressed the desire to mitigate and like winnow down like some of the underlines that he was trading on. I think you said that you had a question about like 500, like the 550,000 like portfolio.
Yeah, I'm having trouble just for me, I'm having trouble allocating it somewhere. So let's say you mentioned that you have buying power and you sell a put when something's at an extreme. But then do you just have buying power sitting around in case it hits the call side, so you end up with a strangle? Because like, what if you end up sitting around for 4 to 6 weeks with unused buying power, and you could have been earning for 4 to 6 weeks? What if that call side never comes? My issue is I'm having trouble allocating this 500,000 somewhere. Even with margin, I could probably allocate 750 or 800. Do I increase my size? So I went from 1 AMD strangle to 10. Do I take it up to 15? Like, I don't know, like it sounds too much. So like out of my trading group, I have the largest portfolio. So I don't know someone with more experience who has a large portfolio that's like, okay, just start trading on Amazon or try to start trading on Google. Do you have it? Yeah. So my question, long-winded question, how do you go about allocating large portfolios or buying power?
Okay, so I think it really comes down to size, where it depends upon the quote unquote universe of underlyings that you trade. So for me, I have a watch list of about like 15 or 20, and I can tell you that at any time there are usually always some opportunities available. So over the past few months, even like right now, there's a decent opportunity in MasterCard with, and recently there have been opportunities in like PayPal. Facebook is also an incredible opportunity where it's trading relatively close to its 52-week low. So I think that as long as and these are like very large cap companies with market caps of like hundreds of billions of dollars. So even if you track like some of the largest like 15 or 20 companies, there should always be opportunities. If there aren't opportunities available, then that usually means that the VIX is trading really low with a VIX of anywhere between like 14 and 16 or 14 and 17, at which time you really don't want to be trading. And it's completely okay for you to, I wouldn't necessarily say sit on the sidelines, because I always have positions on, and I'm sure you always have positions on. I think it's more a question of that during times of low IV and low VIX, that you might have more available buying power sitting on the sidelines that you want, and you feel a little bit of like a fear of missing out, like, hey, the market's going up like every day and I'm sitting on a lot of money, and this point I might as well be long stock, at least I can participate in the upside. From my experience, I never have those thoughts like I'm missing out, because I do know that when the VIX is really low, it's only a matter of time until the VIX rapidly increases, at which time I will then aggressively deploy my capital. And what I'll usually do, let's say the VIX is trading at 16, and then the VIX can go up like 20% in one day. That's happened. I mean, even in September.
Two weeks ago, yeah.
Yeah, it happened like a few times just in September. So if let's say the VIX is trading at about like 15 or 16, and then it goes up to about 20, I will allocate a portion, but I always want to have fear of what happens if I'm wrong, because if the VIX is at 20, that doesn't mean that it can't go up to like 35, and the higher the VIX gets, the more aggressive I'll become. Because once it gets over 30, once it gets to like, and actually, I think just like 2 weeks ago, I think it like briefly touched 30 like intraday, but then intraday it like fell back to like, around like 25 or 26. But the higher the VIX is, the less risk you have. So for me, I allocate capital and my aggression levels based upon how high the VIX is. But when the VIX is trading at 15 or 16, to me, I think that having the VIX trade at 15 or 16 now is comparable to having the VIX trade at about 13 prior to March 2020. Because just like in 1987, when there wasn't much put call parity and calls and puts were trading at similar prices, but then after the crash in 1987, puts started trading significantly more expensive from a premium perspective than calls, because the velocity of risk is to the downside. I think that because the violence of the move in March 2020 was so extreme, where the market fell like 36% in 33 days, I think that the viewers should not consider a VIX of 15 or 16 now similar to how they considered a VIX of 15 or 16 back in like 2019. I think that a VIX now of 15 or 16 is comparable to a VIX of about 12 or 13 back in like 2019. So I think that when you do have a low VIX, that's the most dangerous time, because you're seeing the stock market go up like every day. You're thinking, oh man, I should just be long stock. I have a lot of money sitting on the sidelines. But also, when the VIX is so low, it has all that potential energy where, I'm sure from all science classes, we had like the teacher like hold the ball up and stuff and say, oh, this is potential and this is kinetic energy. And that's your greatest risk when you have a low VIX, because you're anxious to put money to work. But in just a few days, the VIX can increase from 15 to like 30, 35. And that usually happens like twice a year. Like maybe from 15 to 35, it happens like maybe once a year. But still, I mean, hey, if you're short premium and you've allocated a significant amount of your portfolio when the VIX is very low, and then the VIX spikes up from 15 to even 25, which happens a lot. That happens maybe like 3 or 4 times a year. But even if it spikes from 15 to 25 or 15 to 30, which happens a little bit less frequently, you're going to have to defend all those positions, and all your existing positions are going to be showing you a loss. So I would say just be much more aggressive when the VIX is high. And it's actually, in my opinion, the most dangerous times for option sellers to trade when the VIX is low, because not only do you feel like you're missing out, but also the amount of premium that you're collecting is not that much. So you want to inherently increase your size. And it's just it's a very challenging time where you just want to put money to work. And that's actually the wrong time to put your money to work.
Yeah, so like when I remember, I think 2017, 2018, I think VIX might have been 11 or 12. It was so low. You have to go closer to the money to sell something, to make anything worth it. Like, I'm not going to sell for pennies. Like, it just wasn't worth it. So you're right about low VIX being the most dangerous for option sellers. What do you think about this? I don't know if this is like, if people do this often, but I don't usually buy calls. But what I've been doing every time VIX hits a new low, I've been buying VIX calls, just like 60-day. I don't do more than 60 days on like, I do VXX or UVIXI, which is like a 3 times VIX. Yeah, just anticipating that expansion. Is that something you dabble with? Because you kind of mentioned every time VIX is low, inevitably it will receive a pop. So would you buy calls, or is that not? Are you more into selling options?
Yeah, I will sell options. Okay, so UVXY is interesting. I don't trade like UVXY or SPXY primarily because there is significant decay in the option when they roll over the futures for the when they roll over like the VIX futures. It's problematic because even if it's trading at the same VIX level, then UVXY and SPXY will lose money. Now that will then lend astute viewers to say, okay, so then why don't we just sell calls on it? The problem is that you have that quote unquote takeover risk, where if you have a large volatility expansion and you sell calls on some, it can increase from like 15 to about 60. Although, from my understanding, I believe that around like February 5th of 2018, or maybe it was February 18th, the UVXY or SVXY, like they kind of like went out of business, and then they changed how the underlying was calculated. So now it's going to be a little bit less volatile than it used to be prior to February 2018. But long story short, I don't trade volatility. And the primary reason is that I don't believe that I think that volatility is priced pretty well. And the takeover risk for volatility makes it so that I would much rather be involved in selling options in stocks. So I used to sell volatility, and I ran into like a few issues where the trades were challenged, and I just felt that I did better when I was trading stocks as opposed to selling volatility products. However, if I was going to like buy calls or like trade volatility, then I would use more of a slower moving underlying, such as VXX, and I probably would not touch like UVXY or SVXY, just primarily because I think that those products are inherently, they're meant to go to zero, like they're trading products. And I
Mhm.
understand what you're saying, where short term you can realize a significant gain from it, but timing the market is not something that I would want to do. So if I was going to trade VXX and volatility, I would probably buy like one or two in the money options for calls when I felt that VIX was trading at an extreme. So let's say if VIX trades below 15 or even around like 1450, that would be a time where I would feel comfortable buying like a call option that is one strike in the money. And then, maybe with an expiration of about probably 60 days, like, because you want to go a little bit longer, maybe even, yeah, about 60 days, maybe max 90, but my gut feeling is about 60. And then when it pops up, you can take probably a quick 30 or 40% gain in that during the first pop in volatility. That would be the way that I would play it if I was going to do that.
Yeah, so I've only done this 5 times and it has worked all 5 times, but I am relatively new to buying options. Like I've been selling the entire time. I'm not interested in, hoping for like the lottery win. It's more likely to make money selling options, but sometimes when the VIX does get too low, like you mentioned, like right now I'm looking, if VIX hits 14, I will buy VXX calls like 60 days. I find the 90 days, like it will decay too much, and I don't want to pay for that much time because I do want like relatively short term. But I think we're on the same thinking along the same lines. Like if VIX hits 14, I will buy like a 60-day, just waiting for that expansion, just to try to take some advantage of, when VIX is high, you want to sell options, but when VIX is low, I guess buying would be a little better just to get that increased IV. But 99% of my trades are selling options.
Yeah, I think that's good. I would, yeah, I mean, I tend to stick with what works, and like I'm kind of weird. Like I just like to keep things as simple as possible and not change anything that's working. So I know that there are things that I can do to make extra money, because it's pretty easy to recognize when volatility is trading in an extreme. I mean, you can just look at a chart and you can see that, hey, anytime the VIX trade starts closing like below 15 or it gets to about 1450. So anytime since the crash, since March 2020, you can see that it pretty much like clockwork, it's like spiked up. So, obviously like the past doesn't dictate the future, but there's probably a very high probability of profit in making that trade.
Right. And then that's why I've been kind of doing it. Like everyone kind of mentions that same, every time it hits like this new low, you'll get like a short-term pop. So I've kind of been playing that. I guess I'm a little different. I'm always worried there's something I don't know. I don't consider myself an advanced trader. I think like right now I'd be intermediate. So I'm always researching new strategies that I could do, because what if it does work? So recently my newest strategy is just the poor man's covered call. It's just very capital efficient. So when Tesla hit a low of like $550 in March. And instead of buying $55,000 of shares, I spent $30,000 on an in the money call and just selling weekly covered calls, I guess, on Tesla ever since. And Tesla went up from 550 at that point to now it's like 830, I think. And it's been really well. It's my first time doing the poor man's covered call. And obviously it only works if the stock goes up, but very, very happy with how this new strategy has worked out for me.
Yeah, Tesla has actually been great. I think from like January 7th and January 8th, it went up like 18%. Because I remember I was like short calls, like short like 900 calls or something, and then it went up like 18% in like 2 days, and then I had to manage the position. And then I think it fell down to about like the 520, like 530. And then since that time, it spent a lot of time in like around like the 600 level. And then recently it's been going up tremendously. Last year it was incredibly volatile, but this year, even though there's slightly less premium available, it's been amazing. And yeah, I think so. Have you been selling options for 12 years?
Yes. Just part of being in accounting, you have to learn finance. When the 2008 crash happened, my finance professor told us to buy Apple shares, told us to buy Google, and I didn't have any money at the time, but he showed us what he did with trading and buying stocks. And he's like, a recession's the best time to start investing. I never wanted to be the person who had all this financial knowledge and never used it. So I would buy, let's say one of our banks, we have TD Bank, which pays a 6% annual yield. I would just sell covered calls so that I could turn that 6% to 12%. And that's the first option I ever sold, just like a TD Bank covered call.
Yeah, I think that's amazing that to have someone who's been trading for 12 years, yet consider themselves like intermediate. That humble nature and that desire to learn is something that I believe is going to serve you extremely well. Yeah, I think that's amazing. I actually used to work at CIBC, like as an investment banker.
Oh, nice.
So, yeah.
Wait, there's CIBC in the US. Like you weren't in Canada, you were in the US?
Yeah, so in CIBC, in Canada, CIBC has like a very large retail presence. And in the United States, they don't have any retail presence, but they have an institutional presence where they like do investment banking and like trading and things like that. So I worked at their office was at 420 Lexington, and then they moved over to like 300 Madison in New York City. So I worked at that office in their industrials group. So
Oh, nice.
yeah, I have some connection to Canada as well.
Oh, there we
Is
go.
there anything else? I think that this was a very valuable call for the viewers.
There's nothing else on my mind. Are you filming on your phone right now?
I'm not, because no, I think you're oh yeah, I am on my phone, yeah.
Oh, okay, yeah. I'm just wondering. I was wondering if you'd be able to see. It would probably be too small if I shared my screen. But yeah, maybe I'll save that for later. But I just wanted to share my screen just on show people like how I track it and some of the trades I've been doing. A lot of people have been interested. They want to see what I've been doing since the last year. So I've only been tracking my trades on Excel spreadsheet since I started filming my trades on my YouTube channel last year. I'm at like 1,300 lines now, which is all my trades. I haven't been caught for like in Canada, they can turn your trading income into business income and your tax would double. I haven't hit that yet, but it's always a worry of mine. But yeah,
is that something that's discretionary based upon the auditor, or is that based upon like having your trading income be a certain percentage of your overall income?
So it's purely discretionary. So what the Canadian government does, they never want to give you a rule where you can work right below it. They always make it a gray area so that even if you're, because a lot of people just want to sneak by. So if it's like, hey, 1,000 trades you're day trading, I'll do 999. So there's no hard, fast rules. It's always just gray areas. And I think I'm just skirting right below that, thankfully.
I think my did my camera go out or no?
Oh no, I can see it.
Okay, that's great.
All
right, awesome. So yeah, thank you so much. I think that this call was incredibly valuable, and yeah, I really appreciate your time, especially having this call with me on like a Sunday night. It shows the dedication, considering that it's really late and we're like geeking out and talking about options trading. It's amazing. So yeah, I just want to let you know that I have a tremendous amount of respect for you. I've watched a bunch of your videos. I love the fact that you've been trading for so many years and you're still like extremely humble and like open to learning and new experiences. You're tracking your trades. I guess my last question is, do you believe that that tracking all your trades in a trade journal is something that has definitively improved your trading, or do you think it's more an exercise of helping your viewers? Like, does it help you as a trader to track all your trades, or is it more so to like help your viewers? Because for me personally, since I maybe have like maybe 4 or 5 challenge positions like a year or so, then I feel like if I can just mentally review those like 4 or 5 and say, okay, is there something that I did wrong to help avoid this in the future, then that would be enough. But maybe I'm missing out by not putting together a spreadsheet and tracking all my trades. What are your thoughts on that?
I started tracking it mainly for my viewers. They wanted to know a breakdown of the income because initially I was just showing them trades, but now I just do monthly income of how much I've made. But it really helps me see, because I also break it down by strategy, which has been my best strategy. And no matter what I do, every single month, it's always puts that earn me the most. And it's what I feel most comfortable with. I don't think it's 100% necessary to track everything, but I think just the accounting nature, I like numbers. I like seeing everything on a spreadsheet. It's mainly 50% for me because I like to look at it. I also track my, let's say my tax payable come end of the year based on it. But a lot of the times I'll say I started it, I'll say 60% for the viewers, 40% just because I'm a numbers kind of guy.
Awesome.
Yeah.
All right, Bassem, thank you so much for your time. I really appreciated this call. I love your content. In the description of the video that I post, I'll post your channel as well. And I hope that in the future we're able to do this again.
Sweet, that's awesome. Thanks for having me.
Thank you so much.